Hey, Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you're getting sort of value or entertainment out of these videos, I'll ask you a thumbs up and subscribe. Questions, comments, put those below. I want to give you guys a quick update on the macro side of things: interest rates, bond yields, inflation. Bank of Canada's rate hike upcoming next week, October 26th. And then I want to jump over to some provincial updates on the zoning policies, which I think are going to have a potentially massive impacts on the housing market moving forward. So all that in this week's episode. But I think you can't start things off without talking about inflation. It's all everybody keeps talking about. So we had Canada's latest CPI inflation index come out, 6.9% on a year-over-year basis. It decelerated. It continues to decelerate and roll over lower from a rate of change perspective. Remember, we peaked out around 8%, and now we're rolling down to 6.9. However, it was below expectations. People thought it was going to come off more than that, including the Bank of Canada. Of course, that had an impact on bond yields. It had an impact on the Bank of Canada's upcoming rate hike for next week. So as of right now, the market is pricing I believe it's 70% odds of a 75 basis point rate hike for next week. So the Bank of Canada doesn't typically tend to deviate from what the market expects, right? They don't want to upset the apple cart, so to speak. So I would say you can probably expect a 75 basis point rate hike. I was on the Looney Hour saying, hey, I'll go 50. That was more so to keep things entertaining with Keith and Rich. I think the reality is you get minimum 50 and potentially a high probability of a 75 basis point rate hike from the Bank of Canada. So that's obviously going to have significant impacts on the real estate and the mortgage market here moving forward. So, hey, if you got an accepted offer with subjects and you're a seller, you better hold on tight, because I think there's going to be a whole bunch of deals that fall out and collapse after this October 26th rate hike, because a lot of buyers get freaked out, cold feet, etc. So that's something I'll be certainly watching for in the week ahead. Same thing, movement on the Canada 5-year bond yield that continues to march higher. At one point, going from on a daily movement, went from 3.7% to 3.85. 15 basis point move on a single day. Huge movements, which was really symptomatic of financial stress happening in the market, and very much a lack of liquidity. It's funny, I was chatting with one of my good friends. He's a bond trader at a major Canadian institution. So it's always fun to have people that you can kind of bounce ideas off and say, hey, what I'm seeing. Here's what I'm seeing in the housing market on the front lines. What are you seeing in Canada's bond market? And he says, listen, like liquidity, he says, if liquidity was during the heights of the pandemic, during the exact onset when the market was dumping, if liquidity then was a 1, he'd say 1 out of 10. I'd probably say we're at 2.5 out of 10. So liquidity in the bond market, particularly in the Canadian bond market, is very, very thin. And this is actually, you can actually look at, if you just want a simple metric to follow, you can actually just look at what's called the MOVE index, which is basically the bond volatility index. And that shows you that, that by various measures, they've actually got more volatility in the bond markets today than the height of the pandemic. So again, sort of anecdotal conversations, and then you've got the data conversations, the MOVE index showing you another thing. So either way, very, very much a very illiquid bond market, which I'm going to get back to liquidity in just a sec. But again, this all hinges, a lot of this rhetoric is on central banks. What are they going to do? When are they going to potentially intervene? When are they going to slow rate hikes? A lot of this depends on inflation, which again, I continue to be of the view that the central bank, they kind of missed inflation on the way up. I think that they're going to miss sort of the pivot, or they're going to change direction too late. I think that they're over tightening. I think the demand destruction is already in play, and it's going to be severe. If you look at actually a great chart here from my good friends at Variant Perception, one of the leading macro institutions out there, they've got Canada's inflation 6-month forward movement here. You can clearly see their data anyway is projecting a continued deceleration in inflation. Now the question mark is, and certainly my view, and this is something that Greg Jensen of Bridgewater, one of the largest hedge funds in the world, believes, that inflation, while it will come down and decelerate over the next 3, 6, 8 months is that in reality, there's a high probability that you will probably get inflation sticky between 3, 4, and 5%. Because at the end of the day, I think some of these issues are structural, right? We're kind of past peak cheap energy. We do have I think a prolonged labor constraints as people age out and leave the workforce. These are structural elements that could leave inflation elevated, and that's going to be the dilemma, I think, for the central banks moving forward, is that you might be looking at rate cuts with inflation still at 3.5 or 4%, because you're going to have some sort of financial event happening. I mean, all you have to do is, again, we've talked about the bond market being very liquid. In fact, there's a great chart here from Pine Tree Macro, which shows the global liquidity index. You can see that black line there, basically near historical cycle lows, which says every time you sort of get in this range, you actually end up getting some sort of pivot from policymakers and entering, basically flushing the system with liquidity because there's some sort of financial event that they've created. So again, it's not to say a pivot is imminent or coming, but it just goes to show you kind of where we are historically, which suggests that, at some point, something is going to break. And, all you have to do is look at today. I'm recording this video. The Japanese yen, a major currency, one of the major currencies out there, moving 4% intraday. I mean, for a major currency to move 1% in a day, that's huge. For it to move 4% in a day tells you something is wrong. And of course, the Bank of Japan had to intervene in the FX market. But we kind of factor all this in, right? Weak housing market, rates shooting up to really unsustainable levels, a lack of liquidity in the sovereign bond markets, massive volatility in major currencies. This is not a healthy financial market that we're in right now. So that's kind of something that I'm watching. And again, I think central banks will continue to press on the gas. We talked about it. Bank of Canada, probably 75 basis points here on October 26th. The Fed committing to, looks like, 75 basis points at their next meeting. We're just getting so close that, something is clearly on the verge of breaking, but that's kind of what I'm looking at right now on the housing sort of macro front. As it pertains to housing, again, we continue to be in this slow environment. One thing that I'm actually noticing is this pivot from provincial governments, particularly in BC and Ontario. So you'll know a couple of weeks ago, the upcoming premier of the new premier of BC, David Eby, a good buddy of mine, David Eby, has proposed in his platform when he gets officially announced as the premier of BC that he's looking at overriding municipal zoning, where basically he wants to come in and say, hey, listen, on all single family housing zoning moving forward, the provincial government is going to mandate it, not the municipal government. We're going to override the municipalities, and we're going to allow developers to build up to 3 units on a single family house. So they're trying to override municipal governments because they're being too slow in upzoning and they're being too slow in approving projects. And we actually saw this same rhetoric this week from Doug Ford in Ontario, announcing a similar policy measure where he wants to basically override municipal governments. So really fascinating, because I think we have tried a lot on the demand side in terms of foreign taxes, empty homes taxes, various levels of intervention on that side, to see them now sort of pivoting and trying to go on the supply side. Again, as we've talked about, though, the supply side is about to get hammered. So, you can go in there and you can change, zoning to allow 3 units on a property, for example, but you can't force builders to build, particularly when, the cost of capital and the risk that is currently out there in financial markets is not a very enticing market for developers to build. So I still think that projects continue to get shelved in this market. They don't pencil. The reality is developers can't make the numbers work. Construction costs are still elevated. Financing costs are increasing, and the resale market is taking a dump. And so you don't have the ability to really pre-sell at prices that you need to make these projects pencil. So those projects will all come offline, I think, over the next 3, 6, 9, 12, 18 months from now, and that you'll be looking at these supply crunches 4 or 5 years from now. But as it is right now, so again, if you're looking forward and saying, talking about inflation, I think we have to kind of factor all of this in, because, one of the big inflationary environments was the cost of building a house, the inability to get tradespeople, all these like sort of pandemic driven things, I think, are slowly going to correct themselves. And we can see that, in the goods markets. You see companies like Target, Walmart announcing all these oversupply of goods, Nike coming out and saying they've got bloated inventory levels. Funny enough, I was actually just talking about it on Twitter there. As you guys know, I do a bit of real estate development stuff in Calgary. So I went and just booked a trip there mid-November. I got from Vancouver YVR Airport to Calgary. I booked a flight. I booked a 4.5 star hotel, which was where I always stay. And I booked a rental car, all in. I'm only there for about 24, 36 hours, but all in $325 Canadian for a round trip flight to Calgary with a nice hotel and a rental car. I mean, I remember going to Calgary last summer, or 9 months ago, and you couldn't get a rental car, and the ones that you could were these, crappy little cars for $150 for the day. And now they're at $49 for the day, and the price of the hotels come down, the price of the airlines come down. So again, I'm not saying that this is all widespread, but it's just kind of these interesting anecdotes, and I'm sure all of us can find some sort of anecdote out there where I feel like nature is healing. Nature is slowly healing. We're coming out of this pandemic. Things are getting fixed. You're seeing it with, a lot of the supply chain stuff, shipping rates coming way down. Again, I think where it is going to be structural, and I think most people would probably agree on this, again, is on the labor side, right? The end of the day, we do have these labor constraints. The supply of labor is diminishing, particularly with people aging out, leaving the workforce. So I think wage growth is actually going to be persistent, while the central banks are going to try to put the economy into recession. People will inherently lose their jobs. I still think the labor market could be rather firm, and I still think that wage growth will be stronger than we're used to because of those constraints. Again, this is one guy that is simply looking at the information that I have available. I'm making an educated guess. Could be wrong. I know there's lots of people in the YouTube comments here that are going to disagree with me. That's my thoughts. And hey, I'd love to hear your thoughts in the YouTube comments. Again, this is all, at the end of the day, we're all here to basically learn, receive the ability to sort of think critically for yourself and try to form your own opinions. And that's all they are at the end of the day. Nobody has that crystal ball. But what I can tell you is, again, I'm trying to sort of use all this information, use it to the best of my ability, and the best to help my clients in the housing market. So again, long story short, rates going up, another rate hike from the Bank of Canada, more sort of pain for the housing market in the near term. I think central banks continue, to over tighten, and they'll miss the turn. So that's kind of what I'm looking at this week. Hope that helped. See you next week.